Well, a strong durable goods orders number came in and supported the market at the beginning of today's session, but by the end we did sell off in several key indices. We still stayed positive in most of them, except for the Russell 2000, which did close lower, and not only that, but has a bearish intermediate term posture as well. So you have some reasons to be bullish, some reasons to be bearish. As always, it's our job here to look for opportunities within this market. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 27th, 2018. For those of you that are new, first of all, welcome aboard. We're grateful to have you in our audience tonight. Remember, you can go to the YouTube channel and subscribe to it, and while you're there, check out our description area where it'll allow you to sign up for our email distribution list, so that way you can get all of the stocks that are giving you overbought and oversold cluster signals within the S&P 500 sent directly to your inbox. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZee, all one word. We would encourage you to click like and retweet on any tweets that you see us promoting the Market Outlook video if you want us to continue to do these going forward. In addition to Twitter, we're also users of Facebook. We have a group established there. You can check out that group by logging in the web address you see embedded on the logo in front of you. All right, with that, let's go ahead and dive into today's analysis. As you can see, I've got chart 4B pulled up in front of us here. This is the 4 grid that we use to look at the 4 major U.S. equity indices here. And as I mentioned in the intro, we did have a positive day for the most part. The S&P 500 was up 0.28%. Dow Jones was up 0.21%. The NASDAQ led the way, up 0.65%. I noticed Apple was one of the big leaders there in technology. And then the Russell 2000 was our laggard. It was actually down, not much, but it was down 0.06%. Now you'll notice that these charts look a little bit different, mostly because the Russell 2000 now has this darker shade of pink that's showing up over the candle right here. And remember, when that occurs, it suggests that we have a strongly bearish posture on the Russell 2000, which is somewhat unusual to find that the other 3 market indices continue to have bullish market postures, and that's why their background colors remain green, at least from an intermediate term perspective. So right now, you could say that this is a market that's being led by more of the captains, meaning the bigger market cap weighted names out there, and some of the smaller market cap weighted names are the ones that are kind of struggling at this current juncture. As it stands here, you will notice that as we look at the various market sentiment lines, remember those are the longer term view. It's in the orange here, and you can see that we have a bullish market sentiment on the S&P 500 because it's above 80. We have a bullish one on the Dow Jones because it's above 80. We have a bullish one on the NASDAQ because it's between 20 and 80 and rising. And we do have a bearish market sentiment kind of confirming what we learned with an intermediate term perspective on the Russell 2000. So without a doubt, it seems like that Russell 2000 is our fly in the ointment of this current market. But otherwise, you look at the rest of the charts, you look at the S&P 500 and the Dow Jones, NASDAQ Composite, it's nice to see them above rising moving averages. Until that breaks, we assume the trend will continue in the direction in which it came from. All right, let's take a peek at our next chart now. This will be chart 4C for those of you that are following along at home that are premium market scholars. This particular 4 grid will be the same 4 major U.S. indices, and it's also 3 months in length in each of these charts. The difference is how you determine the background color, which of course is created using ThinkScript programming code, which all of you would be entitled to if you are a premium market scholar subscriber. But as you can see, we do have some red arrows starting to creep into the system. Notice that in the S&P 500, we got 2 red arrows yesterday. We retain our green arrow on the top on the moving average, which is still in play since way back here in July. But right now we've got 1 green arrow, 2 red arrows. So it's kind of telling us that things aren't quite as strong as they once were, where the bears are getting a little bit more emboldened here. We do see that with the Dow Jones as well. However, we do maintain our green arrow on the stochastics, but we do have that red arrow coming in on the MACD, just showing a little bit of a loss of pricing momentum right there. When it comes to the NASDAQ, it's kind of interesting to report that it had not had a 3 green arrow signal recently. So it was not like the S&P 500 and the Dow, which had 3 green arrows, but all of a sudden it does as of today. So notice that we've got that green arrow in the form of the MACD coming in to form that third of the 3 green arrows. And therefore, if you're looking for trending opportunities, perhaps within the technology-laden NASDAQ composite, there could be some trend trading opportunities there. When it comes to the Russell 2000, again, no surprise, it's kind of telling us what we learned on the previous chart setup as well. Russell 2000 actually has 3 red arrows. So again, a little bit of a strange market here where not everything is moving in the same direction as one another. We've got the NASDAQ and the tech-heavy areas strong, whereas we've got the small cap Russell 2000 weak. Let's take a look at maybe a longer term chart now. So for that, let's go over here to chart 4D. Remember, this is our 1040 crossover method chart. These 4 indices are the same that we've been looking at so far here tonight. What's different is that each one of these charts is 3 years in length. Each one of the candles is 1 week in length instead of 1 day. And what we're looking at here are crossovers of the moving averages themselves. So each one of these charts has an orange moving average, which is the 10-period exponential moving average, in this case a 10-week exponential moving average, and the blue line would be the 40-week exponential moving average. And we're just simply looking for crossovers of those moving averages themselves. And no surprise, since we've been bringing this up regularly over the last several years, we continue to have a bullish posture from a longer term perspective. Remember, this is not a very sensitive approach to the market, so you're not getting in 1 week and out the next. This is kind of for your longer term, maybe boring type of money where you're just trying to find the big moves where maybe you don't have the ability to trade quite as actively. Well, you can see that we've been bullish for basically 2.5 years at this point, going all the way back here to early 2016 in all 4 of these charts cases. And as it stands right now, you can see the orange lines are nowhere near the blue line, so we don't really have anything to fear from a negative crossover perspective or anything like that. Let's go ahead and take a look at some 12 grid analysis now. Let's go ahead and get started here with an intermarket analysis 12 grid. This will be 4E for those of you that are following along at home. And remember, the background color of these 12 grids will basically highlight whether we have a bullish intermediate term posture using the market forecast indicator, and that would of course be shown with the green background, or if we have a bearish posture according to the intermediate term line on the market forecast, then you would see the pink background color. So as you can see right now, we did have Treasury yields pull back today. Now remember, it wasn't too long ago, it might have been last week at some point, we did the reversion to the mean trade in this class on TLT when we spotted these clusters that were showing up here. So TLT has actually caught a little bit of an upward bid since then, kind of proving out that point that we thought could unfold of a reversion to the mean. Now how long that lasts, we don't know. One thing I could show you while having this conversation is coming back on over here now to, and before we get away from this 12 grid, I don't want to lose my train of thought here too much, but I did want to point out that the dollar did have a nice bounce back day today. Notice that UUP in the lower left-hand corner here was up 0.72% today. So all of a sudden that move that looked like it was destined to head lower had a nice little bounce back rally here today. We actually closed above that moving average. Now, as long as it doesn't go up above this candle, that trend of lower highs and lower lows can continue to exist for the dollar, but it just goes to show you nothing, moves in a straight line. But back to the point about the Treasury yields, I did want to kind of show you another graph here. Let's take a look at chart 4R. And this is going to be the fixed income 12 grid that we have here. And as you can see, it's a little bit more of a mixed bag than you might assume. In fact, I would go as far as saying, if you look at high yield bonds, this chart that I'm kind of circling here on the top rung, you actually have a bullish looking chart right there out of high yield bonds. So remember, not all bonds are created equal. It is true that most of these have downtrends in place, but it is also true that most of them ended up giving you oversold cluster signals here last week. Notice BND, which is an aggregate bond ETF, had those clusters that showed up. Notice corporate bonds in the form of LQD had a cluster signal show up last week. We also had that on short-term bonds. We had it on medium-term bonds. We had it on long-term bonds. We even had it on the TIPS, Treasury inflation-protected securities. We also had oversold cluster signals on the muni bonds, and then last but not least, mortgage-backed securities. So the point is, we had extreme interest rate movements that led to oversold conditions on many different types of bonds out there. So we might be experiencing a little bit of a reversion to the mean rally in many of those names. In fact, I do want to kind of point out something as well now that my mind is thinking of it. Come over to the internet for just a quick second. Remember, on Thursdays, I conduct my question and answer session here at Market Scholars. And it's a class that we conduct, both David and I conduct one of these types of classes every week, where we kind of gather the students together and allow them to kind of perform an Ask Me Anything type of an environment where they pick our brain on various stocks, various strategies, thought processes, et cetera, et cetera. So for those of you that are premium market scholars, here are some of the questions we covered today. We had a long discussion about the new XLC sector, the communication sector, and how that is going to potentially impact all the various other sectors that are out there. We had a discussion about shorting stocks and using buy stops when doing so. We talked about some different exchanges that trade options. We talked about Lazard as a dividend growth investing candidate. We had a good conversation about the pet industry, lots of different ticker symbols surrounding stocks that kind of play into pet lives and the humanization of pets, I guess you could say. We had a conversation about GE and what its prospects, if any, for the future are. Things aren't looking so good over there these days. We talked about Energen getting bought out by Diamondback Energy. We talked about some put-call ratios. We talked about some financial stocks and why they are struggling even if interest rates are rising. We talked about some classes here at Market Scholars where we can find the next Netflix, the next Amazon, both of those companies we've owned in my top-down trend trading class. And then we also talked about some aristocrats that are hitting 52-week highs and lows. So anyway, what caught my mind and why I brought you over here is because of this question right here, thoughts about financial stocks going down on the Fed interest rate hike. We had a good conversation about a particular chart. Let me see if I can find it here. The yield curve chart that we have here for our premium market scholars, chart 4J. And this can help explain a lot why the banks are struggling, at least on a relative basis right now, compared to some of the other areas of the market, despite the fact that interest rates are going up. Remember that this chart on top will show you all those different durations, whether it's 3 months, 6 months, 1 year, 2 years, 5 years, 10 years, 20 years, or 30 years. And it'll give you a sense of how quickly the interest rate environment is going up in each one of those durations. So notice that the shorter end of the curve, this red line here that's represented by the 3-month Treasury yield, the yellow line that's represented by the 6-month, and the brown line represented by the 1 year, they're going up rapidly. If you look at the start of the year, right here, there's a crossover line. Notice that those are going up at an even steeper than a 45-degree angle. On the other hand, you look at the long end of the curve, you look at the 30-year, the 20-year, and the 10-year, represented by the orange, the blue, and the black lines. Those are mostly going sideways. Yes, they did break out here just recently, but since the beginning of the year, or late January at least, these things have mostly just been going sideways, just drifting a little bit higher. So what's happening is you're finding that the yield curve itself continues to flatten and flatten and flatten. And that's what this line down here is telling us, which is the 2-10 spread. And you'll notice that that continues to track towards zero. Remember, when this blue line hits this pink line, you're ultimately going to have that inverted yield curve that you hear a lot of people talking about. So this is not the best environment for the banking stocks that are out there. Do they want interest rates to go up? Sure, but they'd probably prefer to have the longer end rates going up more quickly than the shorter end rates. And right now we're actually getting the opposite of that. So you're getting kind of pinched profit margins at the current time. Let's get back on track with a couple of other charts here before we get to our trade application example. Let's go over here to our foreign stock markets and take a peek at that. So as you can see here, as we look at the foreign stock markets, you did find some of them that were in the red today. So what caught my eye was India. India has really struggled. I think there's a lot of potential for India in the decades to come, but what happens in the short term is anybody's guess. What we do know is that India has really struggled here basically over the last 1 month. Here was 1 month ago today, August 27th, and we've been basically down in a straight line. Now notice we did get an oversold cluster signal here a couple of days ago, so it is possible that maybe we get a bounce, but at the same time, notice that today's candle, in fact, let me right click on that and let me maximize it so you guys can see it a little bit better. Notice that today's candle, I'm kind of pointing at it in the lower right hand corner right here, is now below this candle that was a pretty nice looking hammer candle back here on June 28th. Now notice prior to today, we had 3 candles in a row that were basically sideways right at that level. So we had not broken that support from that candle back in June yet. Today, we can say that we did. So this one is starting to be a little bit more concerning here. Would I be surprised if we get some sort of a quick snapback rally due to some of these oversold signals? No, I wouldn't be surprised at all about that. After all, we had a nice 3-day rally there, a 3-day rally there, a 3-day rally there. So that sort of thing is certainly possible. But what it means for a longer term trend, I'm not quite as convinced that right now is the perfect time to be considering India, at least from a trend trading perspective. So just be aware of that. Let's take a look at our last 12 grid now, which is the U.S. market sector 12 grid. And this is going to be chart, once it pulls up here, I'll let you know. Boy, it's taking its sweet old time here today. Wonder if it kind of got stalled out. Let me try that again. Notice some funny things happening with paper money here. Oh, there it goes. It's chart 4G for those of you that are following along at home. And remember, this particular chart is really your chart in the upper left is the S&P 500. Then the other 11 charts are going to be the sectors of the S&P 500. And remember, down here is the telecom sector. Tomorrow is the big crossover date when the telecom sector becomes the communication sector. And we have, you know, all those companies like Facebook and Google and AT&T and Disney and Comcast and all of those heavy hitters in the media industry going into the communications space. So starting tomorrow, we could really replace IYZ with XLC as in communications instead. But as we look at these, you can see there are actually more pink charts on the board than green ones. It's kind of a little bit suspicious when we see that, but there are a couple of areas that are holding up better than others. Discretionary had a nice day, up 0.34%, nice bounce up and away from that moving average. Healthcare has really been one of the stalwarts of this market. Notice that it is just up in almost a straight line. Even when it pulls back, it's just very gentle in its pullbacks. Unlike what we see below here with the real estate and utilities, those are some pretty violent pullbacks that we experienced there due to some of those interest rate changes. But notice that in both of those charts cases, we do have oversold cluster signals. So again, perhaps there's an opportunity for a quick reversion to the mean type of a move out of the utilities and real estate here in the near term. Notice that the industrials was another area that we've been keeping our eye on a lot more. This one does have a bearish posture right now according to the market forecast, but because it looks like it's starting to establish some support above a rising 30-day moving average, I'm not willing to give up hope on it quite yet. So wouldn't be surprised if we catch some sort of a bounce around that level, just like we've done right over here and right over here in the past. One chart that is a little bit more concerning to me is the materials. This is some really ugly price action right here. Not sure what's going on with that, but you don't see, 5 really ugly down days like that on an entire sector ETF very regularly. So notice that we closed near the lows for 5 straight sessions on XLB, the materials ETF out there. And in doing so, today's low did breach this prior horizontal support area here. So the materials don't look so hot right now, which is a bit curious considering a lot of times the materials and energy sectors kind of work in unison with one another. Energy has remained strong. Even today, it was flat on a day when the materials were down 0.87%. So if you're choosing between the two and you want to be bullish, it does appear that energy is maybe that cyclical area that's withstanding the heat and the pressure a little bit more so than what we're seeing out of the materials right now. All right, so with all of that out of the way, let me come on over here to chart 4A to get ready for our trade application example. And for this conversation, I wanted to go back over to the internet just briefly and remind you guys that when you click on blog up here at the top of the marketscholars.com website, it will take you to our blog items. And many of these blogs, you guys can see whether you're a premium subscriber or whether you're just a free subscriber of ours, including my 9 at 9, which is basically 9 stocks that are up and 9 stocks that are down within the Russell 1000 at 9 a.m. Eastern time each morning. So if you want to kind of get a sense of what types of stocks are set to set the tone for the trading day, even before the trading day begins, then I would encourage you to get in the habit of checking out that 9 at 9. I also post that over on Twitter for those of you that are there. But the reason I'm bringing that up right now is I wanted to kind of highlight one particular stock that I plucked off of the 9 at 9, and that's Xilinx. You can see Xilinx was up here at pre-market by about 1%, and the reason for that is it got an upgrade before the market opened here today. Well, as I come back over here, its ticker symbol is XLNX. As I come back on over here and I pull up that particular ticker symbol, XLNX, that's Xilinx, of course, a technology company, you can see that it ultimately went up 2% by the end of the day. So it was up 1% pre-market. It went up another 1% after the stock market opened, and we closed near the highs of the session. It's a very bullish sign. Remember, most market indices today close near the lows of the session. So for this one stock to close at the highs, that's saying something. It's bucking the rest of the market's trend, and it's kind of dancing to its own tune. As you can see here, this has been a very nice trend here over the last 3 months. Of course, we do have a bullish market forecast posture on it right now, and that's what that green background color is telling us. We also have a rising market sentiment line, so longer term posture continues to be intact with it as well. And of course, we hit that new multi-month high here as of today. We closed at 79.90, and today's intraday high was 79.99. So we only closed 9 cents off of the highs of the day. So all things considered, a very strong day for Xilinx. So as I come back over here to the trade tab, just quickly remind you why it was up today. It was up because looks like one of the analysts out there at Needham and Company started Xilinx with a buy and $100 price target. Now, of course, analysts aren't perfect, and who knows, maybe it takes years before it gets to 100, but obviously somebody out there likes Xilinx and thinks that there's potentially some $20 of upside potential from where it's trading right here at 80. So what I thought we would do here today is focus on a debit spread. Now, what we would be doing is a bullish debit spread. So we'd be buying one call that's in the money and selling another call that's out of the money. So as you can see, the at the money strike would be 80 since we're only 10 cents away from that. So the first one that's technically in the money would be the $79 call. Now I'm looking at the October contracts with 22 days until expiration. So these are the normal monthly contracts here. So what I'm going to do is I'm going to right click on the $79 call and I'm going to go to buy vertical. So I'm not selling this. Remember, a lot of times we do credit spreads in this class. This will be a debit spread here. So 79 is the call that we're buying, and then I'm going to flip this over to an 81 call as the strike that we are selling. Because again, we're going to leave the $80 strike alone since that would be considered at the money. So we're buying one in the money, we're selling one out of the money. And what we've got here is a debit of 88 cents. Now what that means is that $88 is going to come out of our pocket for doing this trade where we're doing, just one contract. Obviously, you'll need to adjust accordingly how many contracts you would end up doing in your paper money. But for this conversation, it's $88 that comes out of our pocket. Now, what's our upside potential in a trade like this? It's over 100% of upside potential. Now, how we get to that 100% return is by having Xilinx go up and through 81. Because this is a $2 wide spread here, but we're paying 88 cents to tackle it or to tap into it. What that means is that we have $1.12 of upside potential. So basically just take the $2 that's between the 81 and the 79 and then subtract out your debit. And that's how I got that $1.12. So we're spending $88 in the hopes that we can make 112 in profit. So that's more than 100% return on risk. Now, this is not going to be a high probability trade. This is a directional trade. You would only want to conduct this trade if you think that Xilinx is going to continue to go up. Because in order to maximize the trade, you want this stock to be trading above 81 on expiration day here in October, which is, again, is 22 days from right now. So with it being only $1 away from there, it's not that bad of a setup. I mean, this thing moved $1.50 today alone. So to say that it couldn't move another dollar higher in the next 22 days just wouldn't be respecting history. We absolutely know that it can move $1 in even a day, let alone 22 days. The question will be, if it does move up $1 in the coming days, will it maintain that? So if you think that the market's going to melt down, or if you're concerned about the Russell 2000 leading to drag the rest of the market lower, then you're probably not going to want to take a bullish trade like this. On the other hand, if you saw the strength of the NASDAQ, which of course Xilinx is a technology-oriented company, then perhaps you think that there's going to be a little bit more strength going into this particular segment of the market. And as long as it goes up to at least 81 in the next 22 days, then we stand a pretty good chance of making money on this trade. So with that, let's go ahead and click on confirm and send. And again, our worst case scenario is we lose $88. Our best case scenario is we make 112. So let's go ahead and send that one in, and we'll see how we do in the morning. All right, well, I want to thank you for joining me here tonight. It's always a pleasure to go to work for you. David will actually be out of the office tomorrow. He's got a vacation planned. In fact, I think he's going to Yellowstone, and the last time he did that, the market's really melted down. So if we have a big down day tomorrow, we'll know who to blame. But all joking aside, I should be back with you guys at some point tomorrow. Remember, I have to do my sector selector on Friday afternoons as well, so it's kind of hard for me to fit that in as well as doing the market outlook video. But we'll figure it out, so plan on hearing back from me tomorrow as well. Until then, best of success with your trades and your investments. Goodbye for now.